Good afternoon, everyone. This is Kathy McBreen of the Spectrum Group. Thank you so much for joining our Spectrum Investor Confidence monthly webcast. I'm going to introduce you. There's two parts today to the agenda. The first part, we're going to talk about our monthly index and the findings, which of course are quite interesting this month because of what's happening in our political environment. And then secondly, we're going to talk about some research that we're just recently completing about the wealthiest investors in the country, those with $25 million plus. So I'm going to turn it over to our president, George Walford, to talk a little bit about what's going on with investors this month.
Thank you, Kathy, and good afternoon, everyone. As Kathy said, this month's index is kind of interesting, but not necessarily not for the most intuitive answers, but the results are a little bit different than perhaps we might think, given what we've been tracking all year around the election. We'll take a look at a number of factors with our index, and as Kathy said, she will talk about the country's wealthiest investors, 25 million plus investors, which is a critical population for our clients. It's research we do about every 18 months, and as Kathy said, we will be releasing the final study results in about 10 days. We're going to let the election settle down before we share everything with the world. So the index this month, and those of you that are familiar with it, it's the measure of millionaires and the broader affluent population level of confidence in a number of key factors, including what they feel about their household in terms of things such as income, the economy, how they're feeling about investing, what issues are concerning them, etc. And historically, we've always seen that the affluent index tends to be a little less optimistic compared to the millionaire index. And last month, which is a little easier to see here, we see that on the top chart that the millionaire index which is blue, and the orange line being the affluent index, were essentially the same. And if you look through the past 12 months at the top chart and down at the bottom, you always see a spread. And it was interesting to us that spread was pretty much non-existent last month, and you go all the way back to January of this year, it was also non-existent. And so now we're back to a more normal course, but that course was created because the millionaires went up 4 points while the overall affluent population dropped 1 point. As I've always point out, it's important to think about these in terms of multiple months in a row. And so you see for millionaires, after a down month last month, they're trending back upwards, where affluent now is 2 months in a row of going downward. So it will be interesting to see a month from now, of course, which would be post-election, what kind of impact this has on people's thinking about their overall outlook. As I mentioned earlier, the key component is what we call the affluent household outlook. And this particular outlook goes back, we show you a year's worth of trend lines here, a roller coaster. But in particular, we now have 2 months in a row where it's dropped. And there are various subcomponents to this, which I think are important to think about and look at. And this is where we see a very interesting trend that's been in place for the last 4 or 5 months. And that is that folks are somewhat optimistic about a number of factors other than the economy. And that's quite of an interesting factor. So overall, as you can see, the household outlook in total here dropped somewhat, as you saw on the previous page. And it's down compared to a year ago, although these are not significantly different numbers. So basically, it's flat year over year. But you start looking at the subcomponents, you see household income is just a little bit higher than last month. But people's feeling about the economy is quite pessimistic. That's an interesting factor. That's one of the key drivers to the index, in particular this outlook. And so that's one that we always want to take a look at, and that tends to drive what people think about the place where they work and also their overall assets. Now, this year and throughout the year, and we'll probably continue it for a few months past the election, we focus on these categories based on what individual responses indicate their political affiliation is. So we broke this down by the 3 major areas of focus: Republican, Democrat, or Independent. And you start seeing some pretty significant differences compared to the overall indice. With Republicans being much more pessimistic about each of these categories, Democrats being far more optimistic, and Independents being either in the middle or somewhat tainted 1/3 towards one way or the other, but typically in the middle. And again, focused down at the economy, where first the overall rating was negative, and you can see that's significantly impacted by those that say that their affiliation or political belief leans towards Republican is very negative when it comes to the economic outlook compared to Democrats. And independents are also quite negative, mathematically closer to Republicans, but still in the middle. Now, this is quite interesting because when we look at everything else, political affiliation doesn't have that significant of a difference in terms of how they invest. But they meaning Republicans and they meaning Democrats and independents, have a far different attitude and outlook about where things are happening in the next 6 to 12 months. This is not just as a result of sort of say the last 30 days, but this has been this way throughout the year.
George, we have a question. The question is, what percentage of these individuals fall within each of the different categories?
Meaning Republican versus Democrat? There's about, interestingly enough, a third. It's a fairly representative. A third falls into Republican, a third Democrat, and a third independent, which means when mathematically they're kind of equally weighted here, and so it really shows you how negative the Republicans are. I should thank you for the question and encourage folks to, if you want to type in a question in the little opportunity to do that, feel free to do that. This month we also went a little bit larger in terms of our analysis and looked at the same similar components by political affiliation, but separated affluent from millionaire. This was actually something that a number of our media partners wanted to take a look at this month. In particular, you look down at the same line down at the bottom, in a little different order, but just the economy down at the bottom, where independent, if it's affluent or millionaire, Republicans are still very negative, and the same thing, the difference for Democrats. Although you start to see a difference between Democrats where the wealthier Democrats are just a little bit more pessimistic about the economy than the overall affluent market. And the same equal to for independent. That is, they're about the same in that case. So it's a different way to look at this kind of insight based on a political affiliation. As I said, we'll continue to do this probably through the end of the year, and then we'll decide if we'll look at it this way again next year. We ask a series of rotating questions, and this is an interesting outcome for this particular question, which we ask about every 4 months, which is, what factor would you most say affects your investment plans today? And the reason it's kind of interesting is political climate for this type of a question tends not to have a significant impact. It really is what the market's doing. It's pretty intuitive, but they're not influenced that much by what's happening in the political market. Looking at the same question over the past 16 months or so, you get into a scenario where, once again, it is the political climate is just not a big factor for driving this particular outlook down.
We have another question, George. What are the key factors driving the negative economy or the positive economy?
We find when we dig down into this question a little bit more, this group of investors, which is not surprising because most investors are, but we find that wealthy investors tend to be far more tuned into information in the media. They're far more read. They read a lot more about investment blogs, etc. They're far more conscious of things such as interest rates being artificially low. They're focused on when will interest rates rise, with a belief that they're kind of artificially low, therefore not artificially supporting the economy. They also are a little bit more knowledgeable about the jobless reports, which may not necessarily reflect higher income jobs or full-time jobs. And so the wealthier folks tend to be more sophisticated and therefore look at the monthly reports on jobs, income.
They're also a little more concerned, they're also a little more concerned in our feedback from our focus groups in that some of them think the market is oversold or they believe the market's already at its high. So those that are a little more negative are thinking that that's an issue that's coming up.
And actually we see that when we look at the next page here, which is when given a choice to talk about what you're intending to invest in the next 6 months to a year in major asset classes, you see that equities, both individual issues and mutual funds, are down or flat. Bonds, because of where interest rates are right now, tend to be flat. We also are starting to see a little reduction in cash reserves, although we also look at people saying they're going to stay on the sidelines. So this essentially is a set of investment categories that are not very exciting, because I think people are waiting for the outcome of not just the election, but the election, interest rates with the Fed, et cetera. And we look at the same factor relative to political affiliation. The category over on the right, not investing at all, you can see is the second. Well, it's either tied or, in the case of Republicans, the highest. The other categories are similar and track the previous page. We are going to move into research that I mentioned and Kathy mentioned with our wealthiest Americans, and Kathy's going to chat about that.
Thank you, George. This is about the fifth time probably that we've done this report. The first time that we did it was around the year 2005. The first time we did it, it was all paper-based. We sent out lots and lots of questionnaires to wealthy households. We found these wealthy households and we hand-addressed envelopes, and we were able to, we did a lot of actually phone calls as well with them. And so since that time, we've been able to keep a lot of those same individuals that participated in our very first mailing, but at the same time, we've also expanded into doing part of the fielding online. So that gives us a whole different base of really wealthy households, and we have to do a lot of scrubbing of the data to make sure that our the individuals who filled out the surveys actually qualify, and we have to do a lot of checking. So we are excited though this year, because this for the first time is showing some really changing demographic trends in our country around the wealthiest investors that we have. This is the first year that we have the youngest average age of all wealthy investors, and a majority of these individuals are still working. So if you take a look on page 14, you can see that 58% of these people are still working. They're not retired. Oh, I have to apologize. Something didn't show up on the screen correctly. On the retirement status, the part that's kind of blurred should say 58% are still working or not retired, 28% are retired, and 14% are semi-retired. It's okay, my hard copy here, but I apologize for the one on the screen. Also take a look on the left. The mean age of these 25 million plus investors is 52 compared to 66 for those of the research that we do with what we call the ultra high net worth, who are represent those households from $5 to $25 million. We'll talk in a minute about why we think why this age discrepancy is occurring. Also, you can see the millionaires are an average age of 62, and 58 are the mass affluent, those households with $100,000 to $1 million of net worth. As you can see, looking below, 37% of millionaires are still working, and only 28% of the ultra high net worth are still working, because they are obviously an older crowd. The other thing that's interesting to look at over on the right-hand side in the bottom, we can show you the number of households that we had that responded that had more than $125 million, and a lot of these were very wealthy young people. So we were very happy with the sample that we were able to find this particular time. If you look at the next page, what becomes important to many people, especially people like me who are not even close to living in this kind of a wealth segment, is how do these people become who they are? Where did the wealth come from? Well, you can see the top occupations are in the middle of the page. A lot of them are professionals, senior corporate executives, business owners or entrepreneurs, managers, and consultants. Now, being a professional doesn't mean that they're making all of their money just from being a lawyer. Now, some lawyers are plaintiff's attorneys and probably do very well, and some are accountants or doctors. But a lot of times what they do is not only work within their own profession, but they might become involved in other things in addition to their profession. So a lot of the wealthiest doctors that we find, for example, have invested in companies that maybe by doing research in the field that they're specialized in, that might be developing new drugs or might be, developing new types of medical devices. So we see a lot of wealth built that way, not just from their profession, but using their professional knowledge that they have. On the left-hand side, the other thing that you see is an interesting trend as compared to older generations is that in the younger households, there are two income households. So not only is this reflective of the wealthiest Americans where both spouses may be working, it's also reflective of what's going on in our society as a whole, where even in the lower wealth segments, you see more and more two income families. On the right-hand side, this is the page that I always show to my children, where I say, look how important it is to be able to get your education and be able to get a graduate degree as well. Almost all of these people have college degrees, and a very large percentage of them have some kind of graduate degree, whether it be a law degree or an MBA or a medical degree. So this is the information if you want to encourage your children to do well at school that you should give them. On the next page, I want to take a look at the very top. You see a little thin green line. We didn't label that. What that is we ask individuals, how wealthy are they? How wealthy do you perceive yourself, and how wealthy do you perceive your parents and your spouse's parents to be? We started asking this question because a lot of times, we couldn't figure out where the wealth had come from. So we thought, well, maybe they inherited it and they don't want to acknowledge it. But as you can see, most people say they rate themselves an 82 out of 100 on a scale of 0 to 100, whether they're wealthy or poor. And they pretty much say that their parents were lower than they are and their spouse's parents were even lower. It's really interesting to find that no matter who we ask these questions to, they always rate their spouse's parents as less wealthy. So someday we will see that change maybe, but I don't know. The other thing that's important, how do these people get away? We'll look at the hours worked per week. 39% of these people worked more than 40 hours. Obviously, actually more than 80%, basically 80% of these people worked more than 40 hours a week when they were in their careers. And 41 to 50 hours, that was 39%. But look at 23% worked more than 60 hours a week. So that's an important criteria as well and why these people are successful. Over on the right are some of the most interesting things that we've also asked, and this is where we see some real differences this time as opposed to in the past. We've always seen where we ask people, what was the most important factor? And they all said, I worked hard. And you can see again, 85% of these wealthy households said it was because they worked hard. But look at the differences in the age groups. Those over age 66, 100% of them said they were wealthy because they worked hard, whereas only 77% of those under the age of 50 said that they worked hard. So that's kind of an interesting twist. Again, education's important, smart investing, taking risk, frugality, being in the right place at the right time, and luck. But look over on the right, running my own business. A lot of those youngest investors are the ones that are wealthy because they were running their own business. And for the first time, look at that inheritance number. 73% of these people acknowledge that they've inherited some of their wealth. Even though they think that a lot of them are more wealthy than their parents, so clearly they think that they're working as well, they acknowledge that they've inherited some wealth. Excuse me. Again, also reflecting some of the things that we see happening in the Silicon Valley, et cetera, taking advantage of stock options or selling a business. Those are all very important, as well as decisions made for me by a financial advisor by these young people and family connections. So how do they feel about being wealthy? Overall, more than half of these individuals worry about their next generation being wasteful with the money, but they acknowledge as well that they think that their happiness is somehow related to their wealth. They know that if they probably weren't as wealthy, they probably wouldn't be quite as happy. It's interesting to note that they have friends and family that ask me for money. Again, that's a generational thing. The younger people are more likely to, the older not. My wealth has brought me unwelcome attention. For almost half of these individuals, that's kind of an interesting thing that has happened. And they still worry about their financial situation. Younger people more than older people, 42% overall. And I wish my spouse was more involved in our finances. Again, the younger people are more interested in that. Some other personal concerns. Not allowing my wealth to be detrimental to the work ethic, educational, or career plans of my children or grandchildren. 83%. That's really a key thing that advisory firms need to understand, because any advice that they can give or any ways that they can help these individuals teach their children some of these values that they believe that they have would be really a helpful thing for them to have. Raising financially responsible children is tied with that. The well-being of their children and grandchildren and the legacy that they leave for their children or grandchildren. Those are all the top things. And still, they worry about their financial positions, 62%. And then the next one I found fascinating. 62% also worry about having someone to care for me in my old age. Now, granted, they could probably pay for someone to take care of them, but maybe it's all more than just paying for somebody to take care of you. And look at over on the right-hand side, we have having someone to care for me in my old age by the lower wealth segments, and they're a little less wealthy, a little less worried about that than those who are the wealthiest. Using my wealth to help others is over 60%, and then their reputation is the last thing that's most important to them. I'm going to turn this back to George, if there are no further questions, to talk a little bit about some of our newsletters.
But there is one question here from the group here, which we didn't touch on, but that is, what do we find, or what is the use of advisors in this population? Do they tend to use more than one?
We find almost all of them use at least one advisor, but more than half of them you have 2 or more advisors that they're using to some extent. So definitely they're using advisors. Now, by the same token, a lot of them feel that they're somewhat self-directed and they manage a lot of their assets on their own.
So it is a very opportunistic target client. I mean, it's easy to always, everybody says we'll go after the wealthy. But the key these days for this particular wealth segment is, one, their average age, and two, which a lot of our research goes into, is how the younger folks, not surprising, want a far different experience from their advisors, technology-based, far more interactive, and far more involved. And so it is something to think about as you're targeting this client base.
And this is a 400-page report, so it's quite interesting. Lots of information in there.
Lastly, the index released every month is part of our high net worth investor newsletter, which is a great monthly newsletter for advisors. It's something that you can subscribe to individually or for a corporate subscription. We thank you very much for joining us. If there aren't any other questions, then we will adjourn until next month.
And if you have any questions in the interim, please email us. Thanks.
Thanks very much.